Crypto risk? Meet your grown-up hedge. CBOE's long-term Bitcoin and Ether futures are here. They could bring perpetual-like exposure to U.S. markets. Stay tuned to discover how this changes trading and who really gains the edge in this new landscape.
For some reason, I've always loved the name CBOE, Chicago Board Options Exchange. It just seems to be one of those places that harks back to a different era of open call outcry trading, you know. Obviously, that doesn't happen anymore. But now CBOE is bringing crypto into normal everyday usage. And this is about futures contracts to be offered by CBOE. Tell us about what's going on there.
They're going to launch these long-term futures contracts. They're called continuous futures. It'll be for Bitcoin and Ethereum. The contracts are going to last up to 10 years, and they're designed to mimic popular perpetual futures. So like a derivative contract with exposure to an asset without an expiration date. These are currently offered by offshore crypto exchanges, but those offshore exchanges aren't so well regulated. I think that's why the regulators went for it. They basically said, okay, people are investing in this stuff. We can either let them invest offshore in these unregulated or poorly regulated markets, or let them invest through the CBOE with more better regulated products. And the way they're going to do it, the product will price daily through cash adjustments to provide continuous market exposure. Again, regulated market. It'll also allow hedging of positions. And I think that's a big deal. Personally, I've owned Bitcoin since it was 15,000. I've never sold any. When it's dipped, I've just bought more. I have a long-term thesis there and don't really care that much about the volatility. It's annoying, but doesn't affect the long-term thesis. But for institutional investors, that kind of volatility can be a problem. They don't like showing those, monthly numbers or daily numbers gyrating all over the place. So they can use hedges to smooth out some of that. And, for them, it's a marketing thing.
Okay. I guess I'm not sure if I'm saying it correctly, but if someone's making a market for these options, do they have to actually own the underlying asset behind it as well?
So yes and no. From a regulatory point of view, depending on the product, they may not need to own the Bitcoin or Ethereum underneath it. But if they don't, they're taking on an enormous amount of risk. So
that's going naked, isn't it?
Yes, in some ways it's not necessarily the right question, only because they tend to do it anyway. In fact, let me ask you a question. In Australia, do you have to wear your seatbelt when you're driving? Is that a law?
It is. Yep.
Okay. I'm going to make this up. For the next 10 minutes, I'm the head of Australia. I'm the emperor of Australia, right? And I have just gotten rid of the law. It is no longer a law that you have to wear your seatbelt. Your seatbelt is no longer regulated by the state. So you have to drive somewhere later this evening. Are you going to wear your seatbelt?
Of course, always.
Right, exactly. So whether the institutions that are offering the other side, the sellers of these options, these perpetual options, whether they have to or not depends on the details of the option. But you better believe, that they don't want to take unlimited risk. They're generally trying to capture a spread. So it's why, and we won't go into the details of this because it would take a really long time and get very complicated. But when you hear these gamma runs or gamma hedging or the gamma short squeeze.
Yeah, getting deep into the Greeks.
Yeah, exactly. Basically, what it means is that a lot of times you have these institutions that are short, say Bitcoin starts to rise, they're taking losses, they have to buy it back, otherwise their losses get too big. So basically they don't want unlimited exposure on either side. So for them it's like a seatbelt. They're going to be hedging themselves, even though the hedging can lead to market activity that amplifies moves, and unfortunately that goes in both directions.
So why is this a milestone for US markets?
If we go back just a year and a half ago, you couldn't even have a Bitcoin ETF, right? It was April of 24 that we finally got Bitcoin ETFs. Before that, the only thing you had was the Grayscale Bitcoin Trust, which frequently traded at a gigantic premium to net asset value and then a gigantic discount. Again, something we've covered in prior versions of the five things. So now you not only have these ETFs allowing people to own things like Bitcoin in a regular brokerage account and just buy the ticker rather than have to figure out how to self-custody, which is not as hard as people think it is. But you have these derivative products. And I think what US regulators are realizing is either provide people a way to safely own the product that they want to buy, or they're going to go to other markets. They're going to go to other places. And this really is, I think, an example of the market exerting pressure on the regulators, saying, regulate this or we're going to buy it someplace else.
Is this part of the changes in the dynamics brought about by the change in administration since last year? Because I think it's much more of a crypto-friendly administration now than it was in the past, and that there would have been a lot more regulation on the table if it had been a win for the Democratic Party.
I think that's mostly true. Although, in fairness, when you talk about a win for regulation, these markets are not unregulated. These are the regulators saying, okay, you want to buy this, here are the regulations, here are the rules. They're actually saying, we're going to provide you a regulatory framework if you're a pension fund and you want to own Bitcoin, if you're a bank and you want to sell options on this stuff. And so I don't know that any of this is a loss for the regulators, but there's no question that the Trump administration has been much more crypto and Bitcoin friendly than any prior administration, although it's not like we can go back that far, right? The Carter administration didn't have to deal with crypto, and neither did President Reagan or, anybody until very recently. But, I think it was also very smart of the Bitcoin and crypto community they were huge donors to the Trump campaign. And, fortunately, one thing that I think was maybe undercovered a little bit, people realized that Barron Trump was a huge contributor to his father's election win because he understood the podcast space. And I think he went to his dad and said, you want to get on these podcasts and go talk. And, one thing President Trump is phenomenal at, I read about him going like on Joe Rogan, walked in, no notes, no prep, literally just walked into the studio. They put a microphone on him and he spoke to Joe Rogan for 3 hours. The guy, he knows his stuff. He knows the things he wants to talk about. And people will say, oh, he doesn't know everything. Okay. But the stuff he wants to talk about, he does know. But he has, his other sons, Eric and Don Jr., those guys, they were big in the crypto space. And I think they understand it. And so, he had people very close to him who were advising him to go in that direction. He got a lot of money from the crypto space and the Bitcoin space. And so, we have a more friendly environment. And I think it's a good thing. I think, better to offer the American people who want to own Bitcoin but aren't comfortable with self-custody than just offer them the ETF. Let these pension funds benefit from the rise in Bitcoin instead of watching other products do better, right? This helps people's retirement. And you could say, well, what if it goes down? Listen, I'm a long-term holder on this. Like, I own this. It's my largest position. So I have my money on it. For people who want to have these derivative products, the options are let the CBOE do this and provide a regulatory framework, or people are going to go offshore and do this in less regulated environments. So, I actually view all of this as a positive, and I think it's okay for the financial world to go to the regulators and say, we want these products. Provide us with a regulatory framework that will provide us with the guidelines where we can do this legally, right? Instead of going behind your backs. This is not a bad thing.